All right. Big day today in the market. We're up. You can see here we are up 3%, almost 3% in the market. Big day. And we have just kind of a little over a week kind of moved up here way over the 200-day moving average here. And so we have VIX currently, or SPX currently trading at 32.04. And we have VIX finally, right? And that's what it took, a big push here to get VIX under 25, right? This is the lowest level we've been in quite a long time. In 3 months, we're at 24, 33. So a bit of a breakout here over the good news today was the jobs report, right? And so we'll talk about a couple strategies here. One thing I'll start with, we're in the middle of we just finished week 1 of our credit spread class, mainly doing put credit spreads in SPX. And we'll talk about that a little. Not too late to join that class. It's a 4-week class. We meet on Tuesdays and Thursdays. Next week, we'll be meeting on Monday because I'll be out of town on Tuesday or driving. But we'll have 3 more weeks. And for those of you looking to get good at one strategy for weekly or monthly income, we're kind of giving you this system or methodology doing basically put credit spreads in the SPX. And Thursday's trade, obviously, that we put on yesterday, one day you got your 8 to 10% just because, you had an unusual move today. But the class is going to function on just something you can do every week, put a trade on, simple risk management, and I think it'll be a big help to you. But you can get some information on SheridanMentoring.com. So let's jump in here. Look at a few things today, a few trades, opportunities. So again, we're definitely in an uptrend here, aren't we? Would anybody deny we're in an uptrend? Anybody? We are in an uptrend. Marilyn said no. Marilyn, we are in an uptrend. Don't tell anybody, but we're in an uptrend. I'm not saying where we're going to go Monday or where we're going to go Tuesday, but we are in an uptrend. You say, Dan, how do you know? Look, we're in an uptrend, right? All right, so here's an example of how I would maybe structure a put credit spread today. So we'll just talk about a few spreads today. So here's an example of a put credit spread. Let me just double check this. One second here. Let me move a few things. And just make sure this is fine and dandy. So this would be a 21-day put credit spread. And 21-day put credit spread. And you can see here, this is the underlying right now at 32.01. And I'm picking the strike to sell in the puts at 30.40. In this case, I'm using a 20 delta to pick the short strike, and I'm buying the 30.30s. And for a 21-day put credit spread where you're picking your short strike by selling a 20 delta, they're going for $1.30, $1.40. I did it for $1.40 yesterday. It's trading at 65 now. So it's going for $1.30, $1.40. mainly $1.40. It's a little bit lower today because volatility has come down, but let's say $1.40 credit. First of all, what is a put credit spread? Put credit spread is a high probability type trade that kind of mirrors stuff in your retirement account. You're kind of a neutral, not just your retirement account, you're more bullish, but it should be a neutral to bullish trade, that high probability trade that you would put on. You're selling an out of the money put, and then you're buying a put 5, 10, 20 points lower to hedge it, because selling an out of the money put's expensive. So what is a put credit spread, or what is a credit spread? A put or vertical is another name for it. You sell an out of the money put credit spread, and buy further out of the money put. So the distance between my short and my long is 10 points. Why would somebody do a spread like this? It's a neutral or bullish spread that makes money if the market sits, goes down even a little bit, or goes up, right? So why would you put one on? It's neutral to bullish. And we're and is this something that you'd consider in this kind of environment? Yes. Why? We're in an uptrend, by any stretch of the imagination, but we're above the 200-day moving average. So, and why do people do put credit spreads on a regular, intentional basis? Because they think the market's going to go up over time. How do you get the probabilities in your favor with a credit spread or with a put credit spread? How do I get? Why is this why are the probabilities in my favor when I do this? Price is 32.01. Yeah, this is a spread I would consider right now. Yes. Would I probably do it this second with the SPX up 88 points? Yes or no? Timing wise, is this generally the best? Would I normally look for days up 88 points to put on a new put credit spread? Yes or no? No. Doesn't mean it can't go up, but this is one I would consider if I were to put it on now. Now, how do I get the probabilities in my favor, or why, whether I was bullish or bearish, if I went and did a credit spread and sold a 20 delta and did it every week, are the probabilities in my favor of winning over time? Yeah. How? If I sell a 20 delta to pick my short strike, this is a 20 delta, what does that mean? It means the delta of my short put is 20. What does that mean? It means there's a 20% probability we're going to finish under 3040 in the SPX by June 26 expiration. So on June 26, which is in 21 days, there's only a 20% probability we're going to finish under 3040 in 21 days. Can it happen? Yeah, but it's about a 20% probability. Is that high? No. So let's flip that around. It means there's an 80% probability that if we sell this spread for $1.40, that if we did nothing and left it there, right? In 21 days, that $1.40 that we brought in, $140, would be at zero, because there's an 80% probability, right? We will not close under 3040 in 21 days. Could it happen? Yeah. Now, what is a reason that we don't just sell it for? So if Cal or Jim or B, right? I love that name. My name today will be D. D says to B, B says to D, right? Why wouldn't we do this? I mean, what it's saying is, If we do put credit spreads once a week on a Wednesday, and we do them 21 days from expiration, if we do it every Wednesday till we're both 114 and a half years old, we'll win probably 80% of the time. So why wouldn't we just sell it? What's the number one reason you wouldn't just do that every week and sell it? It'll work, but why wouldn't you just do that? Just say, I'm going to sell it for $1.40, have no risk management, let it expire, collect my $1.40. Why wouldn't you do that? Why wouldn't I do that? Anybody know? Well, no consistent plan, but why? Well, let's look at this trade. It says we can make $140. What can we lose? What's our maximum loss? If we're doing a 10 wide put credit spread where we're selling the 30-40 put, buying the 30-30, we have $1,000 of risk less a credit of 140. So we have $860 of risk. So I can make 140 to lose 860, right? So if you take 860 divided by 140, that's a risk reward of 6 to 1. Is that a good business model if you were trying to raise money from institutions or hedge funds and say, I have a credit spread system, the probabilities are in my favor. Over time, I'm going to win 80% of the time. But when I lose, I'm going to lose 6 times what I make. Do you think you can raise a lot of capital with that? You have some very good information, right? The probabilities are wonderful, but what will a hedge fund say before they give you $1 million? Can you do something about that 6 to 1 risk reward? Now, question, is a 6 to 1 risk reward on a put credit spread good or bad? What do you think? Is a 6 to 1 risk reward make 140 to lose 860 good or bad? What do you think personally? Is a 6 to 1 ratio good or bad? What do you think? Well, here's the answer. 6 to 1 or 3 to 1. 6 to 1, it's not the 6 to 1 or the 3 to 1, right? What matters is your risk management plan. 6 to 1 isn't better than 3 to 1. You know, there's a direct relationship, right? The higher the probability, right, the lower the risk reward. I could have got a better risk reward, right? So here's a strategy. You agree? Let's take a look. So in this strategy, for a 20 delta, we're picking up $1.40 credit, and we have $860 of risk. And my short strike is 30-40. And we're basically at, 3,200. So how many points do we have till our short strike on the downside? What's 3,200 from 30-40? How many points is that? How many points do we get from the price where we're at now to the short strike of 30-40? About 160 points. So over 21 days, that's pretty good, 160 points, right? That's pretty good. If you look at the expected range over the next 21 days, now this is in Thinkorswim, which is basically a standard deviation. Is the expected range saying we're going to go below my short strike? No. Expected move is 149. My short strike's 160 points away. Let me show you something else here. Well, what if we say, you know what, Dan? I want a better risk reward, right? I want a better risk reward, Dan. So, you know what, Dan? Let me sell, instead of selling a, you know, Dan, instead of selling the 29, excuse me, instead of selling the 30-40 put, right? Instead of selling the 30-40 put with a delta of 20, you know what, Dan? Let's go sell the 30 delta. Let's go sell the 31-10 put, right? So here's what I'm going to do. Instead of selling the 30-40 put, I'm going to come 70 points closer and sell the 31-10 put and buy the 3100. And there's nothing wrong with any of these. There's no better or worse, but now let's look at this. Instead of getting $1.40 credit for risk of 860, that's with a 20 delta. Now, I want a bigger credit, a better risk reward. So now I'm bringing in 210. So now my risk is 790. So I go from a 6-to-1 risk reward with a 20 delta, with a 30 delta. Now I'm getting, instead of a 6-to-1 risk reward, 790 divided by 210 is 3.76 to 1. So which is better? Is this better? Well, it's a better credit, but my probabilities are less, right? So there's a trade-off. You know, 20 delta to me is kind of a, it's good probabilities, but I get enough credit in return, right? If you go, does everybody see that? But as Kevin said, also a 30 delta means there's a 60% probability we could touch your short strike. So I like the 20 delta because it says there's a 40% probability that it would touch my short strike, only 20% it would close underneath it. Still good odds. Now, you could say, well, Dan, you know, to get the real good probabilities, I could sell a 10 delta, or to get a higher credit, I could sell a 40 delta, right? A lot of different ways you can get it. And even, I mean, on a day like today, you would have said, you know, you think on a day like today, what if, you know, what if you go at the money, right? What if you go at the money? Like we're at 3,200. What if I sell the 3,200 put and buy the 3,190? Well, wow. Now I can bring in a $4 credit, right? If I sell the at the money put and buy the other put against it, 10 points under, I'll sell it for $4. My risk is 600, right? It's not that far away from a 1-to-1 risk. But if I did something like this, do I have the probabilities in my favor? No. No. And there's not one bad or one good. And depending on how I do it, I'm not saying I would never do selling at the money, but they're different spreads and I would manage them differently. So generally I look at, you see the reason I like it maybe a 20 delta or something like that, because it gives me good probabilities, but at least there's still a decent return. I mean, your best return, your return at expiration, if you sell at the money, would be 400 divided by risk of 600, 66%, right? But it's very bullish. The one that I looked at, if you look at a 20 delta, all right, let's look at a 20 delta. Let's say the 30-40, what's our potential return at expiration? Not that we're going to wait that long, but what's the most we can make on this? And this is going to be, so 30-30. So I'm going back to my original example. I'm selling the 30-40, buying the 30-30. Again, this is an environment where VIX is still historically high, right, at 24.37. If you take a rounded $130, as Jim says, divided by your risk of 870, you're going to have a potential return at expiration of 15 to 16%, right? Again, this is where the underlying is. This is your expiration graph in 21 days. This is your graph today. Over time, the T+0 or purple line will morph into the expiration line, right? And you say, well, Dan, why don't you go like a 10 delta? Go really far out of the money. Well, here's the problem. If I go to a 10 delta and sell the 29.30 puts, are the probabilities really, really, really in my favor? You betcha, right? If I sell the 29.30 puts and buy the 29.20 puts, it's trading for, let's say, 70 cents. So here's the underlying. My short strike is 29.30. So for 21 days to go, what did we say the expected move was for 21 days? What did we say the expected move was for 21 days? Anybody remember, or can you check that? Thanks, Jim. 149 points. So here, with us at basically 3,200, if I sell, again, I'm using a 20 delta. If I sell the 29.30s, I'm 270 points away. Almost double the expected move, right? This is a 10 delta. So if you were to do this every Wednesday, 21 days out with a 10 delta, would you lose much in your lifetime? If you lived to be 113 and a half, would you have many losing trades? Would you have much work to do? No. Would it work? Yes. Dan, how about if I tested it? Do you really need to test a 10%? Before you test it, let me save you hours and hours of testing. I'll save you all this work. A 10 delta is saying if Patricia back tested from now back to Napoleon Bonaparte, right? You're going to win 90% of the time. Now, Jim says if you live to be 114, you'll be poor when you die. Yes, with property taxes and everything. Yes, it'd be a lot. But the point is, You've got to combine risk management. You want the probabilities to work with these credit spreads, but what's the risk reward here? I bring in $70. What's my risk? $930. So the worse the risk reward, the better the probabilities. Does a horrible risk reward make it a good or bad trade? No. Does risk reward make it a good trade? No. Does probabilities make it a good trade? No. What makes it a good trade is your risk management. It's the person at the controls, right? If you get a beautiful brand new plane, right? Beautiful gadgets, best engines, and you stick me in the cockpit, it's beautiful. Everything's beautiful. Not going to happen. You need someone managing it that knows what they're doing. So again, is there much difference between a 10 or a 12 delta? Your probability of success at expiration for a 10 delta is 90. Your probability of success with a 12 delta is 88. Is there that much difference? No. Would the premium be a lot less between an 80 and an no? I mean, here's a 10 delta, 90% probability we're getting 70 cents, right? We're getting 70 cents. Let's see the difference if we go to a, let's go to a 15 delta. A 15 delta, or let's go to a 13 delta. A 13 delta would be the 2970 strike. So we go from a 10 delta to a 13 delta. 13 delta would be, get you 40, you go 40 points closer to the snake. 2970 by the 2960. So here is a 13 delta. Instead of 70 cents, how much more do we bring in? You bring in about 10 cents more, right? You go 40 points closer, you get 10 cents, 10 bucks more. Is it worth it? I don't know. So now the other thing I want you to think about, let's go back to the 10 delta, right? Let's go back to the 10 delta for a second. Let's look at the return. So 2930 and buy the 2920s. So we're getting, let's say 70 cents. What's 70 divided by 930? About 7.5% return at expiration. So by selling a 20 delta, we started out with a 16.5% return. Here, we're starting with a 7.5% return. See that? And we'd probably have to stay close to expiration. So again, it's all how you manage it, right? There's no right or wrong, but the game, if you're selling a 10 delta, is, or any of these, the most important, what do you think the most important thing in being a successful credit spread trader is? If you're doing it on a regular basis, let's say every week, what do you think is the most important thing? Well, it's risk management, but specifically, keeping your losers not much far from your winners, right? Agree? Because you're going to get some gaps. I mean, was today a normal gap, would you say? Yes or no? Absolutely not. But you get some, right? And so again, your success is keeping your losers not that far from your winners, because you're going to win a lot, right? And it's kind of that sweet spot, because your other concern is if it goes against you, like people were saying, you know, a 20 delta, let's go back to a 20 delta, you know, a lot of times this was what happens, right? So if we go back to the original, selling the 30-40 put and buying the 30-30, the problem is a lot of times this is what happens, right? You know, so here's what happens a lot. Here's the underlying, we're at 3,200. How many times will it happen where we go down, 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 and come up, right? Or go down, right? So you want to you have this twofold thing you want to accomplish in risk management. Let the probabilities work, let it move, but you ultimately can't lose. You can't be losing 3, 4, 5 times what you make. You know, it's going to be a tough business model. You know, when if you lose 1 week, it takes 3 weeks to get it back. And that's really the key. I mean, the most important thing is nothing to do with options. It has to do with the risk management of these things. Because let's face it, if you sell a 15 or 20 delta put or call over the next year, I mean, are you, in other words, are you starting out with the probabilities in your favor when you sell a 15 or 20 delta call or put? Either one. Are you you're already starting out with the probabilities in your favor, right? And then you know, a key to these credit spreads, I think, is doing them on a regular basis, managing the risk well. In our credit spread class, we're taking a little different take on it. We're not, most of you are probably, how many are you used to when you're doing credit spreads strictly by the charts? Maybe when we upper end of the range or resistance, do the call credit spread, lower end of the range or support, do the puts. And I think that's historically how a lot of people do it. We're offering a different approach on our credit spread system, something regularly every week, mainly with the puts. And not that I'm opposed to the calls, but there's reasons for that, right? Especially with the volatility skew. But I encourage you to consider, even coming in a week late here, jumping in the class. Going to give you a different take of how retail traders historically approach doing credit spreads. We're approaching it more risk management, intentionality every week, looking to make X amount of money in a particular period. But it's not the directional, it's not based on the charts. I still think the success of a credit spread system is not your ability to pick direction. It's your ability to be intentional every week, but it's risk management. It's how you manage it, the trade, because you're going to be wrong at times, right? Anyways, well, folks, it was good to just chat with you a little bit about credit spreads today. Thought I'd get into more. I mean, with the, you know, as far as the market at this point, by breaking out over, I'll just make a few comments here, at least my 2 cents, for whatever that's worth. As far as the market, you said to me, what would I be looking at next week in terms of opportunities and stuff? Here's where I would be, again, quoting a friend of mine. How many people know my friend Mary Poppins? Anybody know Mary Poppins? So what did Mary Poppins say? Mary Poppins said, when was it time for her to leave the, I forget their names, what was the name of the family she was with? And she left, right? J. Banks family. And when did Mary say that it was time to leave? Why? Why was she leaving? What was changing? Remember? When the wind changes. Thank you. So again, it just looks, we've broken over the 200-day. We're kind of, I would watch this for a week or so. Again, we're kind of moving up. I like to see some type of a range, right? It's a 6 month, some type of range, some type. And right now, we're just, you know what I mean? It's like mosquito flew out of the house. Where, you know, it's moving, it's trending. Let's just see where this, might be watching this for, you know, 1 to 4 trading days. See if we look for maybe where are we going to start ranging a little bit, right? Because it could trend for a while, right? I mean, that's the thing, you know, when we had this big correction here of 30%, you know, we just kind of stayed, once a few indicators were, you know, once VIX went past 18 and the ATR, which measures kind of the width of these price moves, once they both violated some of the numbers we look at, we just kind of, you know, let it go, you know, until you kind of get range bound. And then we started coming back in, at least for income trades. Now, with this trend, would we continue doing put credit spreads? Yes or no? As long as the trend is yeah, I mean, we're in an uptrend, right? Something would have to bust, right? What would, you know, where would we need to see the SPX to say we weren't in an uptrend, right? It'd have to maybe go through the 200 or something you're looking at, right? What would be signs to you that we were no longer in an uptrend? What would be signs to you that we weren't in an uptrend? Yeah, maybe a poke below the 200-day moving average. Maybe there's something else you guys are looking at, but something would have to be triggered. You know, for me, it could be besides the moving averages, something I'd be looking at the VIX. If VIX started popping over 35 or 40, right? You might look at a down sloping trend line, something, right? But anyways, we're going to continue to look at that. I think it's a good time for this class, but I encourage you to come join us. You can still sign up. Just go to SheridanMentoring.com, and we'll be 3 more weeks of the credit spread class. So thanks for jumping in today, folks. Have a great weekend, and we'll see you next time. Thanks.